less than 0.5% of savings and investment assets in the United States are denominated in precious metals. The 40-year mean market share of precious metals is 2%. If the market share of precious metals and precious metals related investments merely returned to mean, demand for these assets would increase fourfold. And I believe that will occur within 5 calendar years of today. Yeah. By the way, it's estimated by JP Morgan Chase, and it's only estimated because they didn't have data going back that far, that the market share of precious metals and precious metals related assets in 1981 exceeded 6% versus 0.5% today. That's speculative. You don't need to say that demand is going to increase 12-fold. Increasing 4-fold is certainly enough to reward investors and speculators.
Hi, and welcome to this discussion. I've got Rick Rule with me once again. Rick, how are you doing?
Mike, I'm doing great. The better to be on with you again. Thank you for having me back.
It's always great. I just love our discussions. In fact, we got on, we've got a video scheduled, a recording scheduled, and we click a link and we get on together. And the first thing I said was, boy, I have no idea what we're going to talk about today. And you came up with a couple of ideas. And so let's just get into it. So what were we discussing just before we hit the record button?
Just before, there were a couple topics that are fresh on my mind. One is the self-congratulatory prose from the Fed and others about the fact that they have now achieved a soft landing.
Yes.
Particularly soft, of course, for that employed, but we'll leave that aside. And that they may now be able to begin to cut interest rates. The other thing that's of interest to me, something I know a bit more about, is the disconnect in capital markets between the market capitalizations of natural resource companies, which are fairly weak, and natural resource pricing, which is fairly strong. I guess that all begs the question, will there be a recession? If so, when? And if there is, how severe will it be and what will it affect? Certainly, in the absence of a recession, for those viewers that you have who don't think that there will be a recession, the commodities-related equities, the natural resources equities relative to the underlying commodities are as cheap as I've seen them in my career, going all the way back to the early part of the decade of the 70s.
Yes. These things always take everybody by surprise. So once everybody becomes convinced that we've achieved a soft landing and that the future is really bright, that's when there's going to be some big, huge emergency. It never happens if everybody is worried about it. And we've seen almost a majority of market analysts and so on be very worried about a hard landing, about the Fed pivot, about this, about that, that there's a recession due for the last, ever since COVID, basically, ever since they created reckless amounts of currency and debt. And now that the narrative is changing. And most analysts, market analysts, and the public are starting to become convinced, oh, the Fed did it. This, for the first time in history, the Fed has done it, and we've got this soft landing. Is this the point where you would think that we are now basically where the crisis is ripe, where it could happen at any moment? Because in my experience, these things always take everybody by surprise.
I think that's right. And I think for planning purposes that you have to think at least as much about arithmetic as you do about narrative. I will admit to being of mixed minds, a bit schizophrenic. I am astonished at the relative strength of the U.S. economy after a more than doubling of interest rates. I'm astonished in particular that private America has been able to hang in. So make no mistake, I'm one of those who's surprised. I'm just surprised in the other direction. I'm surprised that it's held together so well for so long. I'm in a little community in Northwest Washington, and there is a genuine labor shortage. I mean, a genuine labor shortage. That doesn't mean that there aren't people who are out of work, but they're probably, I'm making this up, they're probably searching for jobs that they're not suitable for, because we're in a place where the starting wage for a trainee at Safeway is $20 an hour.
Wow.
It's a fairly strong economy. I'm also, however, painfully aware of the bad arithmetic around the federal budget. I'm aware of the fact that we have $34 trillion in on-balance sheet liabilities and $120 trillion in off-balance sheet liabilities, Medicare, Medicaid, military pensions, Social Security Trust Fund, that kind of thing. And we service this with a budget that's in deficit $2 trillion a year. So on the one hand, when I talk to people I know, when I look at my community, certainly when I read the mainstream financial press, all is good. All is good. It's not too hot. It's not too cold. And they're going to be able to cut interest rates. When I look at the arithmetic, then it's not so good. I get scared.
Right.
Guess what served me well in life, Mike, in reflection, is that I'm a perennial optimist who's always scared. I've got a little bit of both. The fact that I'm a banker means I'm not looking for unbridled upside. I'm always looking to cover my downside at some point in time. One more point before we move on, Mike. We've talked about this on your show before, but there may be some listeners who haven't listened to prior shows. The way the big thinkers calculate inflation really tease me off. The CPI, which they have sold to your listeners as a cost of living index, is not. It's a constructed index. It's so-called hedonistically adjusted, which is to say they decide what your home is worth, not what the market says. They decide what your computer's worth. And probably more challenging, when it's inconvenient for them, they don't add food or fuel. Right. I like to fly and I like to eat. So that doesn't reflect the basket of goods and services I consume. But more concerning to that is that the CPI doesn't include tax. And tax as a component of your listeners' cost of living is more important than shelter, energy, transportation, or food combined. Yeah. The idea that the CPI purports to be a cost of living index, purports to measure the deterioration in the purchasing power of wages and savings is a fraud. And I think people need to look at that. I'm not saying that people need to be scared. Go huddle in the corner, wrap up in a blanket, buy 7 guns, and go to gold. I'm not saying that, although a little bit of gold would be prudent. What I am saying is that they need to temper the unbridled optimism that they see on CNN or read in the Wall Street Journal with a little bit of simple arithmetic.
Yeah, in my first book, I coined the term the CP lie, because that is exactly what you're talking about. It is the CP lie. It is fraud. And I wasn't even talking about the tax component. That's something new that you have been talking about recently, because you're right. It is the largest component, at least for anybody that is actually making something. If you're producing more than you consume, if you're a successful person, you get punished for being successful. And then on top of it, if you look at the average worker, if you're falling in a tax bracket, say you're below the average income and you're falling in a tax bracket that is 5% or 10% when you get to the end of the year, the actual taxes that you've paid. So your taxes, when it comes to the net benefit in society, your benefit is positive. You're getting more back from the government than you're paying in taxes. But people do not calculate the taxes that your employer is paying on your behalf. And if your job didn't exist, the employer wouldn't be paying those taxes. Therefore, it's actually your taxes. And so there is no such thing as somebody that's paying a net of 5% or zero taxes. If you're employed, your employer is paying matching taxes for Social Security, and they're paying unemployment, and they're paying this and they're paying that. And it comes up to quite a huge sum. So the average worker that thinks that he's in a low tax bracket is being lied to and fooled. And if you incorporate that with the taxes that you actually see on your tax return into the CPI, then you've really got something.
And of course, that's leaving off consumption taxes.
Oh, yes, right.
It's leaving off the tax component, as an example, at the pump when you buy gasoline,
Yeah.
which is substantial. People, it's great that you bring that up, because people tend to assume that that's all baked in the cake. And
Right.
I guess it is baked in the cake. But if one proposes to eat the cake, it would behoove one to understand something about the ingredients.
Yes.
I'm really concerned for, in particular, younger investors and savers who perhaps haven't thought about this as thoroughly as they have, to be planning their financial future, understanding that the CPI is a component of confidence. It's not a measure of the deterioration of the purchasing power of their savings over time. I'm sort of convinced that in my life, the price of most things has fallen in a real sense, but the price of the dollar has fallen faster. We make stuff much more efficiently than we used to. We transport stuff much more efficiently than we used to. We have a global supply chain, although it's creaking. What's changed isn't the ability of the private sector to produce efficiently. That's just got better and better and better. What's changed is the denominator. It's the value of the currency. And I think that younger people need to assume that that circumstance is going to continue to their detriment.
Yeah. The other thing that you spoke about was the deficit and the debt. And I remember back when I was writing my first book, so this is back in 2004, 5, 6, and 7. And David Walker was the Controller General back then. And his office was giving different projections than the Congressional Budget Office. And the Congressional Budget Office had us in deficit for a few years, and then it was going to go positive. And you go back in history. If you download the Consolidated Financial Statement of the United States and you look at the Congressional Budget Office's projections for the future, reality always ends up being 10 times worse. They are so far off. It's total fantasy what they project every single time. And I was saying that there would be $1 trillion deficits someday soon, and here we are at multi-trillion-dollar deficits. When during this period of time, before the crisis of 2008, we are supposed to be experiencing these enormous surpluses. Back when, in the Clinton years, when we supposedly had these surpluses, it's a baloney cash accounting that they use that ignores a whole bunch of factors. If we actually had a surplus, the national debt would have gone down in those years. Right. The change in national debt is the true deficit or surplus. That's all you have to look at. Ignore everything else they tell you, every other accounting method they use, because it's just a bunch of smoke and mirrors. If you owe more this year than you did last year, then you had a deficit, period.
And it's important to look at the whole deficit, Mike. Most people, when they look at the deficit, they look at GDP versus the Fed deficit. They look at the $34 trillion represented by bonds. They don't look at the net present value, never mind the nominal value, the net present value of unfunded liabilities, promises that we've made to each other, Social Security, Medicare, Medicaid, military pensions, the Federal Pension Guarantee Board, the Superfund, Trust Fund, all monies that have been earmarked, but any proceeds that have been appropriated have already been spent and reinvested in 30-year treasuries. It's important to note that the real debt that we face isn't the 34 trillion nominal value of the treasuries or the 27 trillion net of the Fed's own balance sheet, but rather adding that to the $120 trillion Congressional Budget Office estimate of the net present value of unfunded future liabilities. It's very important, I think, that your listeners think about that. And I'm not suggesting that they run away in terror and say it's hopeless. If you quit before you start, for sure you're going to lose. You just need to take it into account.
Yes. And so what was the other topic that you wanted to talk about?
Related tangentially, which is to say, if you, well, maybe not unrelated, maybe if you are concerned about the fact that the easiest way for the Fed to get out of the net present value of the unfunded liabilities is to inflate.
Right. Which you have to mathematically, a debt-based monetary system can't remain constant. You can't have like the same number of dollars per person throughout the decades and not have a deflationary implosion simply because there's interest due on every dollar that gets created.
Well, the other way you could do it is the way that you and I would have to do it, which is to say that you began to save and you spent less. As an example, younger people, Mike, could look at you and I, two 70-year-olds, and they could say, you guys voted yourself all these cool benefits for 50 years. You didn't pay for them. You pay for them. We're going to cut Social Security. We're going to cut Medicare. We're going to cut Medicaid. We're going to eradicate the Superfund Trust Fund. That could happen. The probability of it happening politically is, I think, fairly small. But the truth is, if you yourself were confronted with a systemic deficit and unserviceable liabilities, you would have to change the way that you live and invest. The Fed, well, let me rephrase that. The government, because ultimately they possess the guns, has a different alternative. They can fraudulently reduce the burden through inflation. And my suggestion is that while inflation as measured by the CPI is moderating, that the CPI isn't an adequate measure of inflation. Secondly, my suggestion to your viewers is that they're looking at the next year, and most of them are going to survive 20 or 30 years. So they need to be looking further out. And when they look further out, they need to look at a total debt that exceeds $140 trillion.
Yes, and then divide that by the population of the country, or actually divide it by the number of workers in the country that pay taxes. And you end up with astronomical figures that each person owes, more than they can possibly ever pay. And so the only way out of this is more debasement. And the debasement, what a lot of people don't understand when they say, oh, they're just going to print up currency. Well, the value is being stolen from you, from anybody out there that has any dollars. And if you earn a paycheck or a wage that isn't somehow indexed to true inflation, which is almost impossible because nobody really calculates that. The closest person is John Williams of shadowstats.com. So if prices go up, if you're lucky enough to get a raise, that just pushes you into a higher tax bracket.
Since we're in this gloom loop, Mike, let's make it a little worse before we make it better.
Okay.
Your audience is an audience that's concerned about these things, which suggests us they're probably in an upper income tax bracket. And what that means is that the true liability falls disproportionately on them. If you examine tax receipts, capital gains, and income tax receipts at a blended federal and state level, what you'll find is that Pareto's law applies. 20% of the taxpayers pay 80% of the tax. Those are your viewers.
Yeah.
It's also true that good lip, the 20%, conformably aligns, which is to say that 20% of the taxpayers, 20% of the 20% pay 80% of the 80%, or 4 to 5% of the taxpayers pay 60 to 65% of the tax. And it's also true that performance dispersal curve conformably aligns at least one more time. The top 1% of U.S. taxpayers pay in excess of 40% of the federal and state capital gains and income tax. So when we talk about the liability that faces all Americans, the liability that faces the Americans that watch the Mike Maloney show is much higher. That cheery note this morning.
Yeah, and if they're not high income earners, they're at least exposing themselves to the thing that will make them hopefully a wealthy person one day.
Right.
I do have a lot of people out there that commendably are chasing after knowledge, knowledge of how to get ahead, how to protect themselves, and how to become more successful in the future. What the things that you just said were all how much taxes were being paid, not how much the net is when you include the things that the government is giving us. And I can't remember exactly what the figure was, but it's like the top 10% pay 108% of the taxes when you include all of the benefits that the government pays out. So the bottom 90% is actually paying like negative 8% tax.
Right.
and it gets more and more negative the lower the income. I always sort of viewed life as entrance into Disneyland. And you're in this long line. I haven't been to Disneyland in 50 years, but you're in this long line. You used to buy these ticket books, A, B, C tickets, and there was a cost to them. And if you were in line and you say, oh, well, he makes more than I do, so he'll pay for it. And then he gets up and went, oh, he makes more than I do. And finally, the person that is actually running businesses, employing people, actually creates wealth and prosperity for the world, and took usually most of these people, the wealthy people aren't somebody to be demonized most of the time. Most of them didn't inherit their wealth. They made, if you look at the, Forbes, the list of billionaires, the list of a lot of them, and the vast majority did this themselves. They may have started with something. Some of them started with nothing, but they took tremendous risk and tremendous pressures throughout their lifetimes. As an entrepreneur, the number of nights that you go through without getting a single minute worth of sleep is just mind-boggling compared to the average person. There's been a couple of times in my life where I just had a job, and it was so nice turning that job off with the light switch when I left the office. That part was great. And being able to file a much simpler tax return where you didn't need multiple CPAs keeping track of everything and spending, many, many, many thousands of dollars to be able to file a tax return. So I don't know what the point was that I was making there, but to your point of how much taxes each different group pays and how the burden falls disproportionately, they always say tax the rich. Well, we are.
No. I mean,
we've already gone past this point. When you take taxes away from a productive individual that's running a business, that individual, once you get past a certain amount of wealth, you don't keep cash in the bank or cash in a safe or cash in your closet. Your wealth is determined by your stock portfolio and the business you're running. And, like even Elon Musk, the world's richest man, he doesn't have a whole bunch of cash. What he's got is Tesla stock, SpaceX stock, and so on. And so by trying to take wealth away from him, you are actually decreasing the number of jobs, because all that he would do with his currency or his wealth is plow it into the business further and grow the business, hire more people, create more goods and services, and produce a better future for all of mankind.
Yeah, I think it's important when you're talking about the super rich. And when you look at the nominal tax rates that they pay, they're sometimes very low. The way that happens is because their current account is always in deficit. Elon Musk is able to borrow, against the market capitalization of SpaceX and Tesla and the Boring Company. And so it might be that Elon Musk, rather than having a bunch of cash lying around, has a $500 or $600 million credit facility, which he's drawn down. Now, what that means, because he pays himself very little salary and no dividends, is that his taxable income is nil, because he gets the interest deduction on the money that he's borrowed, which he has in fact invested. What that means is, far from having cash lying around, what he has is debts lying around. Now, these are debts that are very, very, very well secured. Any banker, myself included, would love to lend Elon Musk money secured against his wonderful companies. But the truth is, when people like Warren Buffett criticize the Musks of the world for paying no tax, they need to understand that's because those people have no income.
Well, all of that, if they had paid tax, all of that tax that they didn't pay stayed in a company and created more jobs. So you can just say that that amount of tax that they would have paid created this amount of jobs. Take that tax away from them, those jobs would have never been created. Correct. And so people very often do not see the entire all economics is a closed loop. It doesn't matter what you're looking at. There is another side to it that most people do not see. Frederick Bastiat was just great at the unseen, that which is seen and that which is unseen. And economics is everywhere in economics, no matter what thing you're looking at. There's always something that the vast, vast majority does not see. And that is the dangerous part. That is what limits the growth and prosperity for all of mankind. Hi, I just wanted to take a moment and thank you for subscribing and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer, and now back to the video.
So that soliloquy probably leads up to a discussion of investments that people can make that might help them in the context of inflation. It'll be no surprise, given that I've invested in natural resources for 50 years, and given that I lived through the decade of the 70s when resources proved their worth in an inflationary time, that this would have to do with resources. My postulation, Mike, is that if we don't, and I'm not saying we won't, if we don't have a really, truly severe worldwide synchronized global recession, that a broad spread shortage in commodities will develop sooner rather than later. If we do have a recession, it'll be postponed, not eliminated. If that's true, that means that extractive industry prices across the board will go higher. And that's very interesting because the equity prices for commodity producers, oil and gas producers, base metals producers, and in particular gold and silver producers, suggests that those commodities are headed lower in price. If that conjecture is incorrect, if that widely held precept is wrong, there are superb opportunities in the resource space. The disparity between commodity prices and the resultant free cash flow to commodity producers and the equity prices, the market capitalizations commanded by those producers, is as broad as I have seen it in a 50-year career. Let's review a couple of the subheads. We've talked about oil and gas on your show before. The oil price has been coming down. The gas price has been coming down. It is true that if there is a resolution of the conflict in Ukraine between Russia and the Ukraine, I'll leave that to your viewers to determine the probability of, that there is more downside in the oil and gas price. There's more downside too if there was a revisit of COVID, which stopped air travel again. But in the absence of that, the oil and gas industry outside the United States in particular is underinvesting $1 billion a day in sustaining capital investments. What this means is that the current levels of production will not be able to be maintained if the industry doesn't pick up its capital spending. It isn't deferring capital expenditures because it doesn't have the money. These companies are making a fortune at these prices. They are curtailing capital expenditure because the political class has told them that they're going to put them out of business in 2030. When President Biden asked the oil companies to invest more in oil and gas and says at the other side of his mouth that he's going to have them out of business in 2030, this sort of thing doesn't work. If you believe, as I do, that peak oil demand occurs in 2065 rather than 2030, the oil companies are cheap. The rub is, do they get cheaper? And that really revolves around, do you think that the Russia-Ukraine conflict ends sometime soon? And do you believe that there's going to be a global recession? Even if you believe there's going to be a global recession, what a global recession will do is push out the peak punch point, the peak shortage, from something like 4 and 5 years from now to 7 years from now or 8 years from now. So in terms of inflation-adjusted returns, the arithmetic suggests that the oil and gas companies are cheap, and they have proven to be effective inflation hedges. But the cheapest sector, I would suspect, is precious metals. And I know in the comment section after this interview goes up, people will say, that old man's crazy. Gold hasn't moved for X amount of time. Why on earth would he be talking about gold? That's precisely why I'm talking about gold, because it hasn't moved. Except, Mike, it has. When people ask me when gold is going to move, I say I made substantial additions to my gold holdings in 1998. And it is true for 2 years that the gold price didn't move except for down. But since 1998, the gold price has moved from $256 an ounce to $2,000 an ounce, which is to say an 8 or 8.5% compounded gain for 24 years. When's gold going to move? Well, over the last 2 decades. My suspicion is that the moves become more pronounced in the next 5 years than they have been in the last 20 years. And if that's true, then the gold companies, from the highest quality, the royalty and streaming companies, through the senior producers, through the intermediate producers, through the single asset producers, through the high quality developers, are in historical terms insanely cheap. And I'm not suggesting that your listeners put 100% of their net worth in expensive penny dreadfuls. What I'm suggesting is that gold is so deeply out of favor that the market share of precious metals in the United States, the largest savings and investment market in the world, is less than 0.5%, which is to say less than 0.5% of savings and investment assets in the United States are denominated in precious metals. The 40-year mean market share of precious metals is 2%. If the market share of precious metals and precious metals related investments merely returned to mean, demand for these assets would increase fourfold. And I believe that will occur within 5 calendar years of today. Yeah. By the way, it's estimated by JP Morgan Chase, and it's only estimated because they didn't have data going back that far, that the market share of precious metals and precious metals related assets in 1981 exceeded 6% versus 0.5% today. That's speculative. You don't need to say that demand is going to increase 12-fold. Increasing 4-fold is certainly enough to reward investors and speculators. I find most investors in the world can't spell gold, despite the fact that it's a 4-letter word. Your listeners are probably more sophisticated with regards to that. But the truth is that I think that the disfavor that gold and silver find themselves in is a rear view mirror disfavor. It doesn't take into account debt and deficits. It doesn't take into account the necessity to inflate, and it doesn't take into account the historic cheapness of these assets and their reduced market share relative to other asset classes.
Relative to other asset classes, and since gold and silver are money, relative to currency, the size of the currency supply compared to the size of the precious metals supply. Yeah, I think you're absolutely right. I think that we are going into, now that we've exceeded the 2011 high, and then the triple top that we had over the past 3 or 4 or 5 years. I can't remember exactly what it was. But there was a triple top there, which is substantial resistance, and we overcame that. And so I think we're set up when there is another crisis for just a slingshot move. I think this, it would be a 5 years for the big payoff, like you're talking about, if we don't have some major surprise.
Yeah.
Any major surprise will accelerate that timeline. And I think that in looking at this, assets that are managed, any funds and so on, 71% of all asset managers have somewhere between 0 and 1% exposure to gold. 0 and 1%. And so I fall in a category that can't, in this type of measurement, I fall in the 0% range. There's nobody else there to measure that has as much of their net worth tied up, or as much of their exposure in precious metals. And then, mine is skewed because I use the gold-silver ratio to determine how much gold I'm going to buy and how much silver I'm going to buy with a given amount of cash. And because that has been so out of whack it's been out of whack for the past century, but especially in just the past, during the crisis of 08 and in 2011, it started to revert back toward the historic norm, the mean. But in COVID, it was 120 to 1. It's never been that out of whack. And I bought a bunch of silver during that fall in silver prices when everybody else was panicking. And to me, that's, you're a contrarian investor, but you're watching your back the whole time.
Right.
So, yeah. So being an optimist that is always afraid can be a very good thing.
It's interesting what you said about gold and silver. What I've found, and this goes into psychology as opposed to arithmetic, I think, is that precious metals markets are interesting in that they reverberate between both greed and fear, the two great investment stimuli. I postulate that every precious metals bull market is led by gold because the fear buyer predominates. When the fear becomes extreme enough that you get price momentum, the greed buyer comes in. And ironically, the price move that is caused by the greed buyer reinforces the narrative around the fear buyer, and the fear buyer increases his or her purchases. My experience tells me, irrespective of the gold-silver ratio, that silver doesn't move until the middle of a bull market, that the market needs to be led by gold. When the narrative becomes broad-based enough that the generalist money comes in the market and looks at the relative weakness of silver compared to gold, the silver market absolutely takes off. It moves much faster and much further, but it doesn't move until the middle of the market. We have said before on this show that the most volatile asset class of all are those few relatively high quality silver companies, because there simply isn't enough market cap in that space to hold the generalist money when it comes into the market. If you'll permit me a couple of examples, in the 1970s, Coeur d'Alene, 10 cents to $65. Not a typo. 10 cents to $65.
Wow.
In more recent times, the bull market in the early part of the 90s, Pan American Silver, 50 cents to $45. Silver Standard, 72 cents to $44. You own these stocks not with money that you had set aside for a child's college education, but rather that money that you can afford to lose half of in anticipation of making 10 to 15 times your money. People who are listening to this discussion, please use money that you can afford to lose half of without it changing your decision as to what to have for breakfast. That comment doesn't apply to to buying gold bullion or silver bullion. Buy that to sustain your lifestyle. Buy that because you're afraid. Buy that because it's actual wealth. Buy it because it's actual money. The very, very, very high quality producers, buy those as investments. But the speculations that we're talking about, the 10 cents to $65, the 72 cents to $44, use money that you can afford to lose half of without it changing your decision as to what to have for breakfast. With regards to the oil stocks, only buy them if you drive or use energy. In other words, everyone should own them.
Interesting. Okay, I want to thank you so much for this discussion. For everybody out there, please like and subscribe and put something in the comments about this. So, Rick, where can people find you at?
The most useful work that I do is found at ruleinvestmentmedia.com. At ruleinvestmentmedia.com, if you list your natural resource stocks, I personally will rank them. Go to ruleinvestmentmedia.com, list your natural resource holdings. Please, no technology. Please, no pot stocks. I'll rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues where I think my comments might have value.
Okay. Okay, that's great. That wraps this up. I want to thank you so much for your time and all of your knowledge. It's great. Thanks.
Always a pleasure. Thank you.